Hello, I'm Casey, and this is my macroeconomic prediction for the next 2 years and what it means for investments in alternative energy. I'll start with where the economy stands today, then I'll explain why the indicators moved the way they did, and then after that I'll connect recent fiscal policy and monetary policy to investment returns, and then I'll close with a short outlook and key portfolio takeaways. Please take a look at the chart of real gross domestic product over the last 5 years. We see a sharp drop in 2020, followed by a strong rebound as the economy reopened. Since then, growth has cooled toward a steadier pace. For investors, that pattern matters. Steady growth supports electricity demand, corporate earnings, and overall risk appetite without overheating that can push up costs or strain supply chains. You can sort of think of this as a more stable floor under project revenues and valuations. In terms of inflation, this chart shows the consumer price index on a 12-month change basis. Inflation rose quickly in 2022 and then trended lower. 2 points matter for projects. First, cooling inflation eases pressure on equipment prices, construction inputs, and operating budgets. And then secondly, lower inflation reduces the chance that lenders demand further increases in interest rates or wider credit spreads. Together, these effects make cost planning more predictable, which is especially important for multi-phase builds such as energy storage and electric vehicle charging networks. Finally, unemployment. Here is the unemployment rate from 2019 to the present. It spiked in 2020, then fell to very tight levels, and has eased only gradually more recently. A still healthy labour market supports downstream demand, for example, purchases and usage of electric vehicles. At the same time, the recent cooling helps with wage pressure, staffing, and scheduling for engineering, procurement, and construction work. The result is a useful balance, resilient customers, and a little more breathing room on labour cost and availability. Next, aggregate demand and aggregate supply. Here is the simple cause and effect story. First, on the demand side, stimulus and reopening pushed aggregate demand higher. That raised output and raised prices. Second, on the supply side, bottlenecks and energy shocks reduced aggregate supply that added additional upward pressure on prices. As those forces faded and policy normalized, the economy cooled. Output growth moved back toward potential and inflation began to fall. This explains the pattern we just saw on the three charts. A rebound followed by a normalization. This backdrop sets the stage for how recent policy affects our sector. And then in terms of fiscal policy, this figure highlights how funding is concentrated in batteries and renewables, clean electricity, grid and resiliency. Also, clean transportation. There are two investor takeaways. First, the Infrastructure Investment and Jobs Act builds enabling infrastructure such as electric vehicle charging corridors, transmission and grid modernization, and resilience upgrades. This lowers execution risk because sites are more ready, interconnection is more feasible, and assets are more likely to be fully utilized. Second, the Inflation Reduction Act improves project level economics through production and investment tax credits. electric vehicle incentives, and adders such as domestic content and energy community bonuses. These strengthen after-tax cash flows and help close financing gaps. Together, these laws expand the pipeline and make more projects bankable, even when borrowing costs are higher. Next, monetary policy and financing conditions. So this chart shows the path of the federal funds rate. Rates were near zero during the crisis and then moved up quickly to bring inflation down. For capital-intensive projects, higher rates raise the cost of capital, discount rates rise, and tax equity yields rise. Also, debt service rises as well. That can push marginal projects above their hurdle rates, but however there are offsets. Credits under the Inflation Reduction Act, including transferability and adders, and financing tools offered by the United States Department of Energy improve cash flows and can reduce required equity checks. Many projects will still work when they are structured well, but interest rate levels and timing still matter for valuation. Okay, and then an outlook for the next 2 years and portfolio implications. Please look at the table on the right there that summarises the baseline for the next 2 years. The message is a soft landing, real growth holds near a steady pace. Inflation drifts towards the target by 2026, and unemployment moves only a little higher, but still somewhat higher. And interest rates are expected to ease gradually from current peaks. What does this mean for the portfolio? First, the tailwinds. The enabling infrastructure from the Infrastructure Investment and Jobs Act and the predictable credits from the Inflation Reduction Act support interconnection, charging networks, and overall project bankability as cost pressures cool. Second, the headwinds. Borrowing costs are still above the pre-pandemic norm, so sensitivity to interest rates remains important, especially for highly leveraged builds. Third, the positioning. We should prioritise projects that stack credits effectively, secure long-term contracted offtake such as power purchase agreements or tolling agreements, and have de-risked interconnection timelines. These features protect underwriting if the decline in interest rates is slower than expected, and they capture upside if financing conditions improve faster. Finally, here are my references. All charts and figures in the presentation come from the same official sources I used in my paper, and they're all listed here as well. Thank you.